What's up, everybody? This is the Ask Me Anything show where we open up the mailbox and take a look at some of the questions that you guys have presented. Comment below to get your questions answered live. We've got some pre-submitted that we'll get through here in a little bit. If you guys haven't gotten the free light remote rental course, email us at lane@simplepassivecashflow.com and put the subject line light course so the team knows to get you that sent out to you via email. And then here we go. So if you guys haven't heard of the Simple Passive Cashflow podcast, the thing that I've been doing since 2016, check it out at simplepassivecashflow.com. Also found on iTunes, Google Play, Spotify, Google Play, Stitcher. Let's get into the questions here. So first thing, wait, by the way, if you guys have any questions, put it into the chat box, comment box below. It will send me all these things. I don't know if anybody wants to test it out, say hello, see if it's working. Daniel, there's Daniel. How's it being a daddy now? Well, it's super, you see the bags under my eyes? And my wife's mean mugging me to get off of this AMA. So this is going to be a short one. So I'm only going to be 30 minutes as opposed to the full hour. But it's all right. I'm not complaining. Everybody's healthy. It's all good. But the first question that comes up here, is there any reason to put real estate syndications as a passive LP investor into an LLC or living trust? So for those of you guys who don't know, when you invest as a passive investor, you're an LP limited partner. And so some people, their CPAs or their tax or legal advisors might say, hey, invest through an LLC or living trust so that there's another layer of asset protection. And I'm not giving any legal advice here because I'm not a dummy because they can get into trouble for doing that. So, and therefore, you shouldn't listen to what I'm saying from a legal standpoint. But I'm just telling you, most people I see invest in their personal name because that's the beauty of investing through an LP protection. You don't get any of the debt in your name. You're not a managing member like how I am as the part of the general partnership. So the way I see it, and I think most people invest through their personal name. When I pick up my LP shares, a lot of times I'll invest in my personal name. That said, if your net worth is up there, more than a few $1,000,000 net worth, what's paying $1,000 for an LLC and $500 a year, and it's being a little bit more cumbersome to do. What I would recommend, and this is not legal advice, is definitely don't put like rental properties in an LLC that you're investing through. Rental properties are really dirty assets. They have high liability, people trip and fall. This is why we've kind of moved off of rental properties. They're kind of a pain in the butt. I mean, when you're a non-accredited investor, that may be the only thing you have access to. But, as accredited investors, you are able to invest as an LP, just cleaner. I would probably be a lot more concerned with one rental property than maybe 10 LP holdings. Again, that's just my own opinion, and I'm not a lawyer or anything like that. But consult your own tax and legal person. If you guys need a referral, let me know. I can connect you so you can get those consults. And then, kind of the same question, do we need asset protection as a passive LP at syndications? I mean, the big thing is you're not a managing member, right? I mean, I'm not saying that it's not impossible, but to me, I'd worry about other things in life, like getting hit by the bus or something like that. Switch in questions. Is it possible to cash flow in the Bay Area without 20% down? So as you guys have heard me talk in the past, people have a lot of consults, and if you guys haven't completed your onboarding call with us, make sure you guys do that. Sign up for the investor group, simplepassivecashflow.com/club. Fill out the form there. You'll get entered into a free e-course there also. But I have a lot of free consults that I give to people, and sometimes like the level of sophistication is pretty low, where they'll be like, yeah, I own a rental property, it's in the Bay Area or wherever, I own it outright, and I'm cash flowing really good, right? Cash flowing really, really awesome. I'm like, kind of like, well, it's kind of awkward silence there. And I'm like, well, yeah, because you have such a high equity position and return on equity is so low. Sophisticated investors flex their equity and get it rolling into multiple assets so they can increase their return on equity. If you want to understand this key concept that I think a lot of investors don't understand, go to simplepassivecashflow.com/ROE to kind of understand this concept. But back to the question at hand, is it possible to cash flow in the Bay Area without 20% down? So Bay Area, it's just an example of like a primary market where you're not going to find the rental value ratios to be able to cash flow without putting a huge amount down. Answer is probably no, unless you go to ghetto area like a rough part of Oakland or something like that, where you probably don't want to be in the first place. Person asking this question, you're probably just trying to stick a square peg through a tiny round hole or something like that, or if I'm getting the analogy right. It's just not going to happen. Like, just invest where the numbers actually make sense. The problem with like the Bay Area, Seattle, New York, Hawaii, is just you have so much unsophisticated money there. And I think that's the problem, is like there's just too much competition from dumb money. Get away from where the dumb money investors are at and get to places where there's real cash flow and returns. Most people invest off shiny objects, the luxury type of stuff, the stuff that looks cool, or places in seemingly good markets to invest in, like the gateway locations. A lot of international investors like Seattle, Bay Area, Los Angeles, because that's all they know. They don't know of these other places like Birmingham, Atlanta, Indianapolis, Kansas City, Memphis, Little Rock, etc., that offer great cash flow. You're not going to have as great appreciation, but you're not going to have the roller coaster of the cyclical market that comes with appreciation markets. And appreciation's great, right? But the way I look at things, it's kind of icing on top of the cake. I want cash flow first. And especially for you guys who are looking to leave your day jobs by building up portfolios of passive cash flow, you're going to need to replace your salary. So you're going to need to be going into cash flowing assets. Some people might try to pay half of it, the mortgage down on this Bay Area property to make it cash flow, but that your return on equity sucks. That's a big part of it. If you're only making 5% of your money, I mean, that's your net worth is not growing, and your net worth is ultimately the most important thing. Secondly is cash flow. Right? Cash flow is kind of the oxygen. You need oxygen to live and survive, but ultimately you need to thrive, and that's increasing your net worth. And that can be measured by your return on equity on your money right now. Next question. How can you mitigate the risks of investing in a real estate syndication and protect your money? So a lot of times I'll use the analogy of, a lot of people, when they come into Simple Passive Cash Flow, they'll check out our info page about turnkey rentals. And that's how I got started investing in real estate. I started investing in Seattle, a primary market, just like the Bay Area, where you're not going to find cash flow. So I started to invest in Birmingham, Atlanta, Indianapolis with my first 11 rentals back in 2015. But it's daunting, right? Like, a lot of these places I never visited. I don't physically see the properties myself. I have to rely on other brokers, property managers, property inspectors to kind of do my due diligence for me. So turnkey rentals is a good option for lower net worth investors getting started. But to me, the analogy, they're kind of like little rowboats floating around in the water, right? As the tide goes this way, maybe call it a bad market, the rowboat goes this way. And then, by the way, in this rowboat, there's no motor, there's no oar, you're just floating around. So you get tossed and turned by the currents. When the market goes well, like how it has, your property appreciates, and that's a good thing. But the problem with this is like you're at the whim of the market. And as much as this sounds like it's not the greatest, it's still way better than investing in stock markets and retail investments. A lot of the stuff in the garbage 401k options out there. You don't believe me? Go to my article at simplepassivecashflow.com/returns. I do a little whiteboard exercise where I break down the way you're making money 4 ways with cash flow, appreciation, tax benefits, and mortgage paydown that your tenants are doing for you, and the equity buildup there. So this is why I kind of switched to rental real estate very early in my life in 2009. I was sold on this because I was making 20 to 30% returns on my money, and something as a lame old turnkey rental that has no oil or motor. When you compare it to 8 to 10% in my 401k with the ups and downs and roller coaster effect there. But now syndications. Syndications are kind of like you're in a cruise ship, right? 2 ways, because cruise ships are big. You know, when we have all those Texas freezes recently where all the pipes breaks, passive investors don't feel anything, right? It's nothing. People freaked out, passive investors, but we had to quickly educate them and comfort them that it doesn't matter. You know, like some of the worst repairs were only like 10% of our revenues that month. Where if you are a landlord or investor in like a turnkey yourself, you're scrambling around everybody else to get your properties fixed by the plumbers who, you know, all the rich Super Mario brothers out there trying to, you know, gouge people on pricing because their demand for services were so high. Or in the cruise ship, you know, we've got plumbers, folks like that on staff to knock it out on their salary with in-house staff. So that's a key difference there. The second big thing and why it's a cruise ship is because there's a big motor in the thing, right? We're not only cash flowing like the little rowboat floating around the ocean, but there's a mechanism for propelling ourselves through the currents, and oftentimes propelling us through headwinds and head currents of the water. When you're able to force appreciate the property, which means, you know, rehabbing units to get higher rents because tenants are paying more for those better products, you're able to force appreciate the property, which is different from market appreciation. So 2 different types of appreciation there. Forced appreciation is what you're doing is you're increasing the net operating income, which is either 1 or 2 things, increasing the income or decreasing the expenses. When you do either of those or a combination of the 2, you increase the net operating income. When you take the price of property is dictated by net operating income divided by the cap rate of that particular asset and market. So if you increase the price of the property by, let's just say we increase the revenue, let's say 100 unit property and we bump the rents up by $100. Times 12 is an additional revenue of $120,000 a year. But what did that do to our price of the property? So we divide that by a 5 cap of 0.05. So again, the math that you guys are following at home is $120,000 of NOI bump per year divided by 0.05 equates to a $2.4 million of value right there, all while cash flowing. And this is where like the concept of this is kind of like a slow flip. People like to rehab houses, but this is an institutional way of investing while you're cash flowing, and you're also getting that built up equity pop at the end, which you can harvest through a refinance, which is tax free, and continue to cash flow, or you can just sell the asset and harvest your gains there. So that's just a way of, you know, the analogy of like the big cruise ship, and kind of going back to the question is like, you know, seems like syndications are better, and they are, in my opinion, every way, shape, and form. It has the same leverage, probably has even better leverage buying single family homes, since the larger loans are a lot better in terms of terms. And a lot of it's non-recourse debt, where single family homes is all recourse debt. And by the way, if you're a passive investor, you don't get any of this debt in your own personal name. It goes under the key principals general partner's name in the syndication. And you know, investing, you're asking like, you got the better tax benefits through cost segregations. I mean, it just trumps single family home investing, all forms. We kind of joke in our family office group that, and a lot of our credit investors joke, like, can you tell me a good freaking reason why you want to own rental properties? Like, really, right? I mean, I know you got a lot of kids running around with, you know, portfolios or net worths under $1 million. clamoring about their little flip here or their rental property there, but like it's just not scalable, and it's high liability, and it's a pain. It's complete pain. It is on the path to financial freedom, but once you've kind of pressed the point and become more of a credit investor, it is not the way to go. Um, but the thing I will point out is like anybody can put together a syndication offer, right? Anybody, it's a lot of it's just digital marketing, right? Pulling the right person off Upwork or Fiverr to put together a pitch deck, put together a video. How do you really determine who's legit and who's fake out there? It's really hard. I mean, it's really hard to tell the difference between a good institutional operator that's been around for decades and a newbie who's on their first, second, fourth, fifth deal, still working their IT job. Maybe they're an engineer, as I used to be, or maybe they're still playing doctor on the side. It's really, really hard to determine this. And the best way to mitigate this, and as I'm finally getting to the damn answer to this question, is how do you protect yourself? Well, I think you have to build up a community around you, other peer passive accredited investors that actually drop 50 grand into multitude of these deals so that you can, and find out who to invest in, more importantly, who to invest, who to stay away from, right? But the network takes a while to develop. I mean, when I invested the first time, I lost all my money because I invested with the wrong people because I didn't have the network to tell me to stay away from those particular people. If you guys want to hear more about that story, go to simplepassivecashflow.com/fail. Read all about it, the lessons learned there. But let's see if we, so we got a user submitted question here. Thanks, Dan, for submitting this in. What changes do you forecast for syndication strategies as interest rates raise in 2023? I mean, when interest rates rise, what happens? Right? Why do they raise interest rates? Well, they're trying to cool off the economy because the economy is doing well. That means cap rates are going to likely be going up too. So this is, I keep coming back to this, like cap rates and interest rates, they go up in tandem, up and down, up and down. People freak out all the time because interest rates go up, but if you play around with like the analyzer for these deals when they're doing value add real estate, the interest rates really don't really matter too much. It's very counterintuitive, and it surprised me in the beginning. But when you're force appreciating these properties or in the cruise ship, powering yourself past a market, the low interest rate, which is just one cell on the spreadsheet, doesn't really impact things too much. But not to downplay it, right? I mean, when interest rates go up, the market is doing well, and therefore you should be getting higher than projected rents. So I kind of welcome higher interest rates because that's when that's when all the other 30 assets that we own, that we locked in good long-term debt, and we're going to reap the rewards of a good economy is going to come to fruition, and we're going to be able to capture that, do refinances, sell. That's when we're getting icing on top of the cake, which is the market appreciation, which we don't really account for. We try and put ourselves in a good position so we can get lucky, but we don't assume it in underwriting. But yeah, I don't care at the end of the day. You don't care what the interest rates do because it doesn't really impact things. In fact, it's an indicator that things are going in the direction that we want to go anyway. So, I mean, if interest rates go even lower, which they could, I mean, yeah, we just lock up even more long-term debt. So it's really a situation of like heads I win, tails I win. And I think the only losers in this whole equation are the people not in the game sitting on the sidelines, and people who don't buy like things that hold their value or go up and down with the pace of inflation are unfortunately the people who are going to lose in this. And not to get into any political discussion here, but that's unfortunately what separates the wealthy from the poor. The poor just they're unable to participate in things that has their money not degrade in value over time, where the wealthy are able to buy assets, rental properties, stocks, bonds, mutual funds. Not a big fan of those things, but they still go up with the pace of inflation, as you're seeing in the stock market today. But thanks for submitting that question, Dan. If you guys get any more questions, feel free to submit it. We've got about 10 more minutes here left. So I had a question come up. What is a cap rate and how is it calculated? So the cap rate is, so two things here. I can answer this question two ways. So cap rate is essentially what the property performs at percent. What's your rate of return if you use no debt? So for example, if I had $1 million property that made me 20 grand a year and I had it all paid off, it would make me, and assuming no expenses, any of that type of stuff, it would be 2% or a 2 cap. It's kind of the industry speak. So some people will they'll look at cap rate as how does what's the yield on a investment, right? So they say, well, what's the cap, right? But the way we look at it, we don't really go off of cap per se, because oftentimes cap rate is heavily manipulated by brokers. Those, God love those brokers, right? They're always trying to sell you on the property, make it look better than what it really is. And it's always I see caps these marketing pieces by brokers and people trying to sell properties where 12% cap, yeah, whatever, man, that ain't happening. I mean, what's probably happening is that they're leaving expenses out of the picture and not including any of that type of stuff to make the cap appear that it's higher. When you actually show real expenses, the caps come back to where it really is. So this is a classic sucker play to get unsophisticated investors to bite on a property, or at least just get eyes on it. This is the classic, put this in Craigslist, the 14% cap, people click. It's kind of like clickbait. But the other type of cap rate that we talk a lot about in syndications is, what do assets trade for? What is the prevailing cap rate of these types of assets in this particular submarket or market? So what's a submarket? A submarket is a particular area within an MSA. So take a huge MSA like Houston, you might have several dozen submarkets in that large MSA. So, and then even within each of those submarkets, you have different levels of assets, ranging from Class A assets to Class C assets in different asset classes, right? So self-storage, multifamily, mobile home parks. But let's just, for this example, let's just talk about multifamily asset class in a market, or so let's just break down Houston MSA. And I'm just kind of spitballing these cap rates. I don't know if these are exactly right. They float up and down, they change. They don't change too much, but they change from time to time. But generally for the Houston MSA, Class A assets might be in the 4 to 5 cap rate range, meaning that they make 4 to 5% for investors if they don't use any debt. Of course, that's what sophisticated investors do. They use debt to magnify that 4 to 5% return, often 2 or 3 times or more. So for a Class B asset in Houston, maybe you're looking at low 5s, and then Class C, mid 5s to 6s range. But now what you really have to do is that's kind of bad data, because you're looking at this huge Houston MSA. There's, like I said, there's a few dozen MSAs within Houston. But let's just say you take an MSA such as Katy, Texas. A lot of our investors live in Katy, Texas. It's a nice place to live. It's on the higher end of the spectrum. Even though it's farther from the city center, your cap rate there might be, for a Class A building, might be in the low 4s. For Class B, might be 4.5, and for Class C, might be in the low 5 cap rate. Whereas you take a more rougher area of Houston, such as the south east quadrant, just pick a rougher part of area, your caps are going to be higher. Therefore, you're going to make a higher yield. But it's not always as simple as that number is higher, because when you go to a rougher area, your collections are going to suffer. You're going to have a harder clientele to work with. Just going back to the real basics, which if you guys want to download or get the free light course, which teaches you a lot of this stuff, you can send an email to Lane at Simple Passive Cashflow, put light course in the subject line. I won't get that sent over via email to you to get access to that. But every market has these submarkets, and you're trying to find properties in maybe the B and C class area, which is kind of the sweet spot, right? It's not war zone properties. It's not the high-end properties. It's stuff in the middle. And that's when you look at cap rates, you're asking, well, what kind of asset class, what kind of submarket you're in, and what kind of class you're in, A, B, and C. And that's what we're talking when we talk prevailing cap rates. And for those of you guys who've enrolled in the Syndication e-course, which teaches you all about how to be a good passive LP investor, how to vet deals and figure out what is a good assumption for the reversion cap rate or the exit cap rate of a deal, right? You want to find a property, or you want to see the underwriting of a deal to have the reversion cap rate, the exit cap rate, or the assumed cap rate at exit to be higher than your entrance cap rate, which is your prevailing cap rate. So just taking what did I say before? Like a Class B property in Katy, Texas submarket might be a five cap, for example. What you want to see is a reversion cap rate of 0.5% to 1% higher than that to assume for a softer, weaker market. Why a softer, weaker market? Well, because we don't know what's going to happen in the future. Therefore, let's be conservative and let's figure out, let's run our numbers based on a softer market. Why? Because it's good to be conservative, because stuff happens, and when things go well and the trade winds are in our back, we all pop champagne bottles and rejoice. But when things don't go well in life, things typically don't go always smooth all the time. You wish you would have underwrote in this fashion, so there's some wiggle room there. So those are kind of, go back to the question. This question, I kind of read it two ways. Simply put, cap rate is kind of what is the, without leverage, what is this property making as a percent yield, and then what is the prevailing cap rate of the building or an asset at this time. Let's see what else is on this docket. So just to kind of piggyback on this, should I buy in a high or low cap market, and why? So a high cap market have higher returns, as opposed to a low cap market have lower returns. So the bad thing, you would think, obviously, well, I want higher returns, right? I'm after a high cap market. But high cap markets typically go off of more Class C type of areas or less primary mainstream areas. So there's a con of going after, cap rate hunting is a term, right? You're going after you're just sorting big lists, looking for the 7, 8, 9, 14 cap properties. There's hair on it. There's a reason why it's so high, right? Whereas you pick a solid market that's not going to go anywhere, that I wouldn't invest in these places, but like the Bay Area, Los Angeles, New York, you're going to find properties that are in the 3 cap range, which is very low yield, but it's very solid and stable. Nothing's LA, San Francisco, and we all talk about mass exoduses just to get everybody excited, everything, but they're not going to go anywhere. There are always going to be cool places to live. People are always going to want to live in California or Hawaii. The caps are going to be low there. Yields are going to be low. Why? But maybe because people are still dumb enough to invest there in the first place, so they don't need to go high. But if you go out to more tertiary markets, you're going to find higher caps. So it depends on what your strategy is, right? If you're an investor that wants to you're already to end game, and I define end game as your net worth is $4.5, $5 million or more, and you just want to coast the rest of your life. You're not incredibly concerned about making doubling your money again and again and again, but you have $4.5, $5 million. You just want a steady stream of cash flow, and you just want to buy a 3 cap building, apply a little leverage to it, and just reap the rewards of that, and see the natural market appreciation go up and down and up over time. Then that's cool, right? But our strategies are we kind of go off with mid to high cap areas, so we can be cash flowing on a monthly basis. Where the low cap markets, you're not going to cash flow on a monthly basis unless you have a very low or high equity position in it, which isn't great for return on equity. So the trade-off there. So I can't answer this question for you. I'll just tell you what we do. We buy properties in mid to high cap markets. We don't go to the extremes, right? We don't go to the podunk towns. Like everybody talks about Boise, Idaho, but Boise, Idaho is a super, super small market. That makes me uncomfortable. We want a cash flow day one, and we want value add force appreciation, which can happen anywhere, even in LA, even in New York. Just those deals are just kind of impossible to find because people would bid those properties up. There's a lot of unsophisticated investors there. But yeah, we kind of focus in that mid to high cap market. But that kind of brings us, unless there's any other live questions, that kind of brings us to the end here. Again, if you guys want to email me for that free light course, send an email lane at Simple Passive Cash Flow. Tell your friends about Simple Passive Cash Flow podcast. Check us out. And we'll see you guys next time. Bye.